In 1819, a farmer in Alabama looks at his land. He bought it 2 years ago with borrowed money. They told him cotton prices could only go up. That land was the best investment possible. That credit was easy and the future was bright. Now cotton has lost a quarter of its value in a single day. The bank is demanding repayment of his loan. He cannot pay. The land he bought for $1,000 is now worth $200. And the bank is not going to wait. This story will sound familiar. Because it is exactly the same one that repeats every time a bubble bursts. And in the 19th century, it burst many times. Welcome to Season 9 of Everything Has a Price. So far we have covered the foundations of economics, money, banks, markets, supply and demand, and the evolution from feudalism to industrial capitalism. Now we enter the territory of crises. Of collapses. Of moments when the entire system seems to fall apart and the rules have to be rebuilt from scratch. Because economic history is not an upward line. It is a succession of booms and busts, of bubbles and panics, of mistakes and lessons. And we start at the beginning. With the panics of the 19th century. When there were no central banks, no regulators, no safety net. When a financial panic could destroy a country's economy in weeks. The United States was a young country in 1819. Barely 43 years since independence. The War of 1812 against Great Britain had ended, and the country was riding a wave of economic euphoria. American cotton fed England's textile mills. Agricultural prices were rising. And land in the South and West seemed like a sure bet. The Second Bank of the United States, created in 1816, contributed to the problem. Instead of acting prudently, it opened branches in the most speculative areas and issued credit generously. State banks did the same. Paper money flooded the economy, fueling inflation and land speculation. Then the correction arrived. The price of cotton collapsed. Farmers who had bought land on credit could not pay. Banks began foreclosing on mortgages. The Second Bank, which had lent too much, now demanded repayment all at once, contracting credit brutally. The result was devastating. Massive bankruptcies. Widespread unemployment. Land prices fell between 50 and 75%. Debtors' prisons overflowed. Entire towns in the American West were left half empty. It was the Panic of 1819. The first great financial crisis of the United States. The political consequences ran deep. Popular hostility toward the Second Bank of the United States grew until President Andrew Jackson destroyed it in the 1830s, vetoing the renewal of its charter. Jackson distrusted centralized banks and paper money. He wanted a system based on gold and silver. But eliminating the Second Bank did not eliminate the panics. Without any institution capable of controlling credit expansion, more crises followed. The Panic of 1837, triggered by another land bubble and uncontrolled speculation by unsupervised state banks. And then the Panic of 1857, when the failure of a major Ohio insurance company sparked bank runs across the country. The pattern repeated with almost mechanical regularity. Credit expansion, euphoria, bubble, panic, contraction. And every time, the most vulnerable paid the price: farmers, workers, families without savings. And it left a lesson the country would take a long time to learn: easy credit can create prosperity, but it can also destroy it. Half a century later, an even larger crisis shook the world. And this time it was not just American. It was global. In 1873, the euphoria was about railroads. In the United States, in Europe, everywhere, railroads were being built at a frantic pace. Investors poured money into railroad companies, many of which never turned a profit. Speculation was rampant. The trigger was the failure of J. Cook and Company in September of 1873. Cook was one of the most important bankers in America, financier of the government during the Civil War. When his bank collapsed from excessive investments in railroads, panic spread like a shockwave. The New York Stock Exchange closed for 10 days. Something unprecedented. But what came next was worse than the initial panic. What followed was a long and painful period that historians call the Long Depression. From 1873 until, according to some economists, 1896. More than 2 decades of deflation, high unemployment, and weak growth. In the United States, unemployment reached 8% in 1878. In New York, 1 in 4 people was out of work. In Great Britain, entire industrial sectors were depressed for years. Deflation was constant, prices kept falling, which may sound good for consumers, but is devastating for anyone who has debts, because debts become heavier when prices fall. Some monetarist economists point out that the underlying cause was gold scarcity. With the gold standard in place, the amount of money in circulation depended on how much gold existed. And there was not enough gold to sustain global economic growth. Only when new deposits were discovered in South Africa and the Klondike at the end of the century did deflation begin to ease. The Long Depression taught the world that crises were not passing storms. They could last decades. If the 19th century panics prove anything, it is that without a lender of last resort, the financial system is extraordinarily fragile. And no episode illustrates this better than the Panic of 1907. The trigger was almost absurd. A speculator named Augustus Hines tried to corner the copper market. He failed. And the failure exposed connections to several New York banks that had financed the operation. Depositors, upon learning this, rushed to withdraw their money. One bank after another suffered runs. There was no central bank. There was no Federal Reserve. There was no institutional mechanism to inject liquidity into the system and stop the contagion. So one man did it. John Pierpont Morgan, the most powerful banker in America, gathered the leading financiers in his private library in Manhattan. He literally locked them in and refused to let them leave until they agreed to put up money to rescue the banks in danger. Morgan committed enormous amounts of his own capital and convinced others to do the same. It worked. The panic was contained. But the fact that the stability of the financial system of the world's largest economy depended on the will and the wallet of a single private individual was terrifying. 6 years later, in 1913, the United States created the Federal Reserve. Its primary mission, to ensure that a J.P. Morgan would never again be needed to save the system. That there would be a public institution, not a private magnate with his own interests, capable of acting as lender of last resort in moments of crisis. It was the most important lesson of the 19th century. And it took nearly 100 years to learn. What makes the 19th century fascinating is the regularity of the pattern. Roughly every 20 years, a major crisis shook the economy. And every time, the more thoughtful voices identified the same causes: excessive speculation, uncontrolled credit, blind faith that prices would keep rising. But between crises, the memory faded. A new generation of investors, bankers, and speculators arrived, convinced that the rules had changed. That this time was different. That the mistakes of the past belonged to the past. The economist Charles Kindleberger, a century and a half later, would formalize this observation in his work on manias, panics, and crashes. Bubbles, he argued, follow a predictable sequence, a displacement, such as a new technology or a new market, that generates real opportunities. Then euphoria, when everyone wants in. Then excess, when people borrow to invest. And finally panic, when someone discovers the emperor has no clothes. The 19th century was a perfect laboratory for this theory. Railroads were real. Cotton was real. Growth was real. But speculation inflated prices far beyond what reality justified. And when the correction came, it was not surgical. It was devastating. For the families living through these panics, the experience was devastating. There was no unemployment insurance. No social benefits. No safety net of any kind. A factory worker who lost his job in the Panic of 1873 had nowhere to turn. If his savings evaporated because the bank went under, there was no deposit insurance to give him his money back. If he could not pay his debts, he could end up in prison. Literally. Families depended on private charity, on churches, on community solidarity. Many fell apart under the pressure. Children dropped out of school to work. Forced migrations were common, entire families moved searching for any kind of employment. And the cruelest part was the unpredictability. A farmer could do everything right, work his land diligently, produce good harvests, and still lose everything because a bank in a distant city had speculated on railroads. The crises of the 19th century made it clear that the market economy, without regulation or social protection, was capable of generating immense human suffering. That realization took decades to translate into concrete policies. But the seed was planted. The idea that someone should protect citizens from the shocks of the market began to take root in those years, and it would blossom in the following century. 3 ideas to take away from this episode. First, the financial panics of the 19th century followed a recognizable pattern. Easy credit, speculation, bubble, panic, contraction. From 1819 to 1907, the dynamic was essentially the same. Second, the Long Depression showed that crises could be prolonged and global. They were not passing storms but structural transformations that could last decades. Third, the absence of a lender of last resort made every panic potentially catastrophic. The creation of the Federal Reserve in 1913 was the institutional response to a century of instability. These 19th century panics were devastating, but in a sense they were dress rehearsals. The real catastrophe was waiting in 1929. A stock market crash that would trigger the worst economic crisis in modern history, change economics as a discipline, and forever transform the relationship between the state and the markets. That, next time.